Today, and you'll probably hear me say this a couple times as people trickle in, we're really focused on helping people understand how to build a story to then sell that story, to get resources they need in order to execute what they're trying to do. So we're going to kind of use a metaphor of a startup company. I will just share that this works really for any kind of product, whether it's an internal product in a large corporation or an external product in a large corporation. The goal here is to convince decision makers. In the case of a startup, that's investors. In case of a company, that may be someone who controls a budget, to invest in what you want to do, and to be able to communicate what you're doing and why they should do that. So at the end of this, you should be able to have a bit of a better perspective and understanding of what that decision maker cares about, and can actually walk yourself through the exercise in order to craft your story. And this exercise was developed over about a 5-year period when I was running Betaspring, a startup accelerator very similar to Techstars, based out of Providence, Rhode Island. That ran from 2009 to 2014, and we funded and put through our boot camp right around 90 companies. And as we progressed, we saw great companies, great entrepreneurs, many of whom just didn't know how to tell their story, didn't know key aspects of their story, and really didn't know how to communicate how they were creating value for the folks they were trying to convince to either join their team, become customers, or invest in their companies. So we created this framework, and it has helped a number of folks, both startups at Betaspring. I've also given this in different exec ed courses to corporations, and I hope everyone finds it useful today. So with that, we'll just jump in. You should see on your screen something that says building your story in the upper left-hand corner. And we're actually going to start with the idea that you have a startup company or you have a product that you're looking to convince people to invest in. With equity investment, generally speaking, the potential payoff has to be this giant idea. It needs to be potentially worth billions of dollars, because the risk reward balance between an early stage equity investment, it's so high risk that when someone is investing at that stage, they need the potential of a huge reward. And so if you're looking for equity dollars, then just keep that in mind. There are other forms of capital as well, revenue, royalty, debt, et cetera. But this will really be focused on an equity startup. So on the right-hand side of this diagram, you see future. Well, the first thing, and mostly what entrepreneurs really focus on is their big idea, right? Do they have a big idea? Everyone gets really psyched about that. They get pretty good about telling their big idea. That is this billion-dollar idea. But what a lot of entrepreneurs don't realize is that once an investor has validated, which they can do very quickly, that your idea could potentially be a billion-dollar idea, they just check that box and then they move on. And they stop thinking about the value of your startup, and they start thinking about the risk-adjusted value of your startup. So just like a public company stock, the value of your company today is really the potential future value of your company, which may be billions of dollars, risk adjusted for all the risk in the arc of the company as of where you are right now. And so the value of a company really is just the sum of all of its profitability in the public markets, generally all of its potential profitability over the lifetime of the company, so 20 plus years. And so if you're talking about risk adjusting that to today, with a startup where you're very early stage and have huge amounts of risk, the investor will start to now look at that risk. And there are many types of risk, but we're going to focus in on the 3 that are common to every single startup: the team risk, the execution risk, and the market risk. And team is exactly what it says. Do you have the right team? Do they have the skills and experience necessary to navigate building a startup? Execution falls into anything from, can you build a product? Can you hire people to build the product? Can you hire an external team to build the product? Can you build a sales channel for the product? And can you take that product to market? And then market risk is, even if you do all of those things, once you put it out to market, will people actually use it, or will people actually buy it, or will you create value through people using it so that somebody else will pay you money? So there are the other types of risk that are very common in, say, bio or pharma. There's research risk, which typically is borne by governments and universities. There are regulatory risk, which you see in life sciences quite a bit. But you also see it in other markets. For example, Revival Brewing Company is a beer manufacturer, distributor. There is regulatory risk in some things that we might want to do, which we have to decide whether to take or not if we're launching new products. So, or trying to distribute them in new ways. So, and then there's intellectual property risk, which other companies have. But the core three, team, execution, and market, really are the most important for an early stage company. What I'd like to do is walk through this diagram a little bit more, and then we're going to switch over to a Google Sheet, and I'll actually build out kind of the story of a company. So you see the first column there, team, execution, market. To the right of that, you'll see at the bottom, credibility. This is where you build credibility. You do a number of things to build credibility to prove that you can actually execute the next column, which is the story column. So it's great to say, we're going to launch a platform, get 1 million users, and then monetize that platform in some way. But no one's going to believe that you can get 1 million users. You have to take steps in order to do that. And we'll walk through an example of that. It'd be great if some people could just, if they have anything that they're currently working on, just put that in the chat to Jane so that we have some guidance on, can kind of focus in the story that I'm going to build. So if anybody would like to do that, it's just private, right, Jane? It's not shared with everyone, and we'll keep the details. We'll keep the details private, but I might share the conversation in a specific way.
The chat will be open to all people which are engaged.
Okay, so everyone that's engaged will see what you chat. And let's see if I can open it as well. Yes, I can. Okay. So a couple other questions people typically ask that this is designed to answer. One is, how much money should I raise? So you see there's a little fundraising amount portion right in the story column at the top. And then, how much money should I raise? That, how much time should I be looking to raise money? So generally, for a software startup, which is what we'll focus on today, you're really looking at what I like to tell people to do is figure out something that you think you can get done in 6 months that can create value for your business. Give yourself 12 months to do it, and then give yourself another 6 months to raise the next round of financing. So you're really looking at 18-month cycles. And if you're lucky, that can compress because you actually can get something done in 6 months and only take 3 months to raise funding, but generally give yourself 18 months. Let's just step back I'm going to step back one more time and look at the top graph, which is value versus time. So that's value of your startup company. So the other question people have is, well, how much is my company worth? And, how do I value it when I go out and raise money? So in theory, the value of your company goes up as you mitigate your risk. So as you build out your team, as you execute more in the market and prove that your team can do things, and as you get more customers or more partners bought into your platform, then in theory, you'll see that first bump is a dotted line. Your value of your company goes up because you've lowered the risk of the company. And then it actually goes up when you close the money and people buy out from outside of the company, outside investors buy into the fact that your company's worth a certain amount. So as you reduce risk, the value of the company goes up, and then that keeps going in cycles. We're going to just show one cycle, but as you go through the life cycle of your startup, this can be used over and over and over again to kind of iterate over once you've executed the story piece, that becomes credibility for your next bigger thing that you're trying to do. So I'm going to now just look at this chat real quick and see if anybody has put anything out. There's a few ideas here. Okay, so
we can also wait for a few more people to engage, and then I can jump in.
Okay. So one of the things, so I can take an example, and I can do a software example, or I could potentially do a beverage company example, which seems to be applicable to a lot of folks that have been writing in here because they're more kind of like physical companies.
We have a couple people in each. We have a couple in the Q&A, so whichever one you feel more interested in. It seems like there are a few more though in consumer products.
Okay, we'll give
Give everyone one more second.
Yeah, give everybody a second, and I'm going to just switch over to the. Okay. Why is that not? There it is.
Just briefly while we're waiting, I just wanted to touch base. We will have this pre-recorded, and anyone that is interested in re-reviewing the material as we're going through a lot, feel free to reach out to bootcamp@mit.edu. But we also will send out an email to anyone that tuned in today with the recording. We may have some modifications, but it should have all the information which we reviewed today.
Okay, so everyone should see a Google spreadsheet, and that I'm going to start filling out. So we're going to take a big idea out here over on the right, and I'm going to go with a software startup for now. And so let's just say we have a financial app, mobile app for consumers to settle up debts. And that's a big idea. You can think of it, Venmo is a great example of that. And you're looking at impacting a lot of people. You're looking at moving a lot of money. In theory, you should be able to become $1 billion company doing that. And you have a team. Let's just say that you are a startup, kind of a CTO. You have a CEO / let's say you have somebody that worked for a startup in business development before. So you have someone with some biz dev experience in startup land. And you have a CTO that has built a product in the financial space for a large company, but they've never done a startup. And you two have gotten together and are attempting to do this. So you got the idea because this was a while ago, before Venmo existed. You were trying to pay your share utilities with a roommate, and needed to move money around, which is a solved problem, I will acknowledge. But before then, it didn't happen often. So what you have done is you built a mock-up of the workflow of the product, which could just be screenshots. And you all have market tested that with 30 people, and that really just means you've walked them through the slides. So this is extremely early stage, and we'll go over this a couple times so that we can see how this company could grow. And now you need to raise money in order to build the product. So you need to have you want to build a prototype. So ultimately, you're going to need to raise a couple $1 million in order to actually get the attention of banks and be able to plug into a network to move money. But first, your next step, so you haven't done very much. So the purpose of this exercise is to show you that even if you haven't done very much, there are ways to then get resources that you need. So you market tested this, you built a mock-up of the workflow. Now you need to build a prototype, and you don't have any money. The goal of the prototype would be to just have several friends, use the product to test it out. Maybe 20 people, 20 users is your goal. So you're trying to take it from a market test of 20 users to several friends actually using the product. In this case, because you can't actually move money around, what you're going to do is you're going to build the front end of the product, but you're not going to build the back end of the product that actually moves the money. You're going to do that yourselves by writing checks that people give you. They settle up with you, and you're going to mechanically Turk this problem. So you need to you're missing a designer, right? So we'll just say that you need some kind of user experience person. So you need a user experience person, and you're going to then know that you need to add a user experience person to the team in order to do this. You are now, in order to get several friends to use it, you need to build the prototype. You need to identify people who are willing to trust you with their money. And you can do that. You can do that stuff inside because you have a CTO and you have a CEO, but you don't know how to design it. So you need to add your user experience person to the team. So now you have a user experience person in your team. You have 3 people essentially all taking pretty low amounts of money to work on this because you believe in the idea, but you still have people that you need to pay, right? So generally in the companies like this, which is a little different from consumer goods, because in consumer goods you need money for materials and inventory, et cetera. The people make up the bulk of the costs. So now I'm just going to make up very theoretical salaries for people who are living in third-level cities in order to create a budget, and don't take these numbers to mean anything. So you have a $90,000 annual budget. Let's just make it $100,000, $120,000, just because travel, et cetera. So you need about $10,000 a month to survive. So if you're going to give yourselves 18, and you're going to say, okay, it's going to take 6 months to do this, but let's give ourselves 12. Then you're looking at, and then another 6 to raise money. Then you need, and then 6 months here. Then you now need $180,000. So your budget is $10,000 a month. So a total budget for this entire time is $180,000. So you've answered the question of, if you had this dream scenario, then you need to raise $180,000 and you need to add a user experience person to your team. Now, there's a little bit of hand waving going on here because you haven't built out how you're going to get your 20 users. But in theory, you can create a list of people, right, who may be willing to play this game with you as you build out your product, to create something that you can now raise money with. So let's see. Share this question. User experience person, there's a question from the audience, says user experience person is for identifying problems. And the answer is, they're not for identifying problems. They're really for making sure that people will use the product, and that what you have at the end of the day is something people are interested in. Because many times people who are in technology space will be very good at functionally building out the product, but they won't really know how to build out something that people are going to be willing to use. Yeah. So the unicorn team is business person, technology person, user experience person, and generally technology people are the hardest to find. Designers are very close right behind that, and then the business people are relatively straightforward to find. So if you find yourself as a technical person, or a designer, you're actually in pretty good shape because you can do a lot without actually having structured the business. These are all, sorry, that is wrong. You're right. Someone's correcting me here. This is a year. So $180,000 a year, not $180,000 a month. So $180,000, and that's actually not for a year. This is for 18 months because that's for the entire duration of the fundraising, as well as, and I'll just color this so it's a little more obvious. So the goal here then is you just created a story, one story, which may be plausible, may not be plausible, of where you might be able to go out and raise $180,000, which in the US right now, that is a relatively straightforward amount of money to raise if you are willing to engage in a top tier city or a second tier city with angel investors and really develop relationships. I'm not going to address how you engage with angel investors or how you find them in this seminar, but there's a lot of opportunity online and as well, even if you're not located in those cities. But generally, raising money in the larger cities is easier, even if you're not located there. Plugging into those networks would be. Another question of how founders how much they should initially invest for themselves. I like to tell people that if they have a job and they're at this phase, then to try and get as much done while someone else is paying for you to live. Generally, how much you invest yourself depends upon your resources and what you can invest. I don't think people should kind of bottom themselves out because a desperate founder is not a founder that is able to raise money convincingly. That can create problems that the investor can see very, very easily. So it's okay to invest some money as long as you can afford to lose it and not put yourself in any kind of like significant risk that's gonna cause issues when you're raising money, trying to convince people to back you. In this scenario, I'll just point out that the reason people are investing in this is because of the team, right? They might like the idea, but generally at this stage you have a team, and just to address the valuation of the company. If you're raising $200,000 with this team and this kind of idea, and you have done a little bit, but you haven't done a lot, you're probably going to raise money if you've found some mentors. So let's talk. I'm going to talk a little bit about this. You need a user experience team. Other ways you can build value in order to get the maximum value is you should probably have a mentor or advisor network. You should have identified several key advisors. That is one way that early stage teams can build value without having to spend money. You should be able to convince people to spend some time with you in order to lend you their expertise or their network in the beginning without getting paid. In some cases, you may give them some small amount of equity in the form of stock options in order to serve that purpose. But definitely having a group of advisors will mitigate your team risk and show people that you're willing to talk to people and get them to work for you and spend their time with you. And that's one way to mitigate the team risk. On the execution front, even if you're not a designer, I have here, you've kind of built a mock-up of the workflow. You could even just sketch that on paper, scan it in and do a walkthrough in that way. You don't have to if you don't have a coder or you don't have a designer, it doesn't have to be perfect. It just shows that you have something that you've been able to test with people. Obviously, these days, things are a lot easier to create than they were even 10, 20 years ago. So people are expecting something that may be a little bit more refined, but that's where you go find someone maybe from the Rhode Island School of Design who's a student who you try and get on your team for some equity. So another interesting question just flew by. So the question regarding I have identified 2 very competent team members that have collaborated before, but they've only agreed to jump in after an investment is raised. So the person's doing everything themselves. So in that case, the way you would tell that is that you've identified team members who are going to jump in kind of in the story. So you have team members, they've worked together before. Right now, it's just you. They're serving potentially as advisors, and they are interested in becoming co-founders once you have actually raised money and can afford to pay them. There are plenty of people in the world, say most, that have to get paid in order to survive. So it is not unusual to find co-founders who are not able to join your team until after you're able to pay them something. Another interesting and relevant question is how to get funding when investment in a prototype is large. So generally, when someone asks that question, I find that it's because they need to do some more work in towards breaking out exactly what a prototype is. So when you have a big problem, there are a few things generally in the life sciences space, but not typically in the software space, where people in the software space, typically folks will envision something very large to build and try and think that they're going to raise resources to build everything. But that's just not how the world works anymore. Now you need to break that up into very specific pieces of functionality in order to very specific pieces of functionality in order to test the usability of that functionality. So what you have to do is think about your idea and build it out. So in this case, right, they would need, in theory, if they were building the whole product and being able to move money around, they would need a significant amount of money to participate in the banking network. So to get around that, they're building the piece that they can control, which is the prototype, and they're going to work on the back end to kind of settle up everyone without having to plug into the banking network. That will be another step. So what I'm going to do is actually just, I'm going to move down one, and we're going to kind of imagine that this is now the credibility, and then this next stage is now the story. So you've done the first stage, you raised $180,000, you're able to kind of meet your goals, you now have 20 users, and you're kind of magically moving money around for them. Now, what you found is that it's actually going to be too difficult to move money around for them. It's going to take too long to get to that place. So you don't want to do that anymore. You've changed your big idea, and this is very common and something investors look for in teams, is that they're able to learn from what they've done and then adjust so that they can actually do something. So your new big idea is a financial app to keep track of expenses and help people know who owes them money and who they owe money to. So there are apps for this now that didn't exist 10 years ago. One I'm intimately familiar with is called Splitwise, used by a lot of folks to do exactly that. So now now you've gotten rid of this problem of having to integrate with the banking network. While you were building this, Venmo came along, PayPal came along, and they made microtransactions easy. And so now you know that you can potentially partner with them if you have a big enough set of users. So now you just have to focus on getting users. So you have a nice prototype where people have, there's a back end there. You built out a back end for users, you built out a back end for registration, you have a look and feel, you have a name. Let's just add that. You have this prototype that people have used, and you've gotten good feedback on it. Now your next step is you actually want to you realize that you need to build out more functionality related to sharing expenses. You really now are looking to take the next step, which is 200 users. Now that you don't have to move money around, you realize, okay, this is, we can support more people. And so Now you're looking to do what I'll just call a true MVP, minimally viable product that you can launch to people that you don't know. And you don't really need much more. You have the same team. So you've kind of done this pivot, and you need to now understand how to build a marketing campaign to reach a larger number of folks. So notice how I didn't go from 20 users to 10,000 users. When you're growing, ultimately you may have a goal of, let's just say 10,000 users. I think that's probably realistic of what you want to build in order to gain traction, to convince investors you know what you're doing. But don't think of it as, what do I do to get 10,000 users? Focus first on your first 200 users, then your first 1,000 users, and then your first 10,000 users. So you're going to actually build several different marketing campaigns to grow your user base. And it could be going from, the first one could be more of like a hand selling technique to get 200 users, which won't work for 1,000 users or 10,000. The second piece may be that you're launching so you're actually going to build and launch an MVP, and then you are going to and then iterate for 6 months. Okay, so the marketing campaign is not designed to attract investors. That was a question that just came up. It is designed, I'm talking about a marketing campaign to actually get your user base. So investors will be really looking more on how many users do you have, and and they will think about how you got them, because they're going to want to understand how you got them and whether it's scalable beyond that. But the marketing campaign is not to market to investors. That rarely works. I have not seen that work effectively. So in this case, you're probably going to need a little bit more money. We're going to kind of copy and paste what we had before, but you're going to need to spend some money, some kind of budget for growing your user base. So let's just do 2,500 a month, and then we'll get a little money here in terms of, this is $225,000. So you need a little bit more money. Now you may decide, okay, I have deepened my investor network. I'm going to raise a little bit more money, and I'm going to invest in other things. This is definitely a skeleton of a launch plan. What I'm trying to get people to think about here is what are the things they can do to. So here you may find an advisor that has deep consumer app experience, right? They may be somebody that people understand and know the name of. So the goal here is to build 10,000 users. You probably are going to need more money than that. So I'm just going to up this budget to 20 a month, because I think that's more realistic. So you're going to look to raise another chunk of cash, about double what you were raising before. Typically, what we really see is people who are probably going to raise more like 500,000 to $1 million at this stage. So that takes them to another level of fundraising. But it kind of depends. I've started at the very early stage, what I would call kind of a pre-startup. So if a $360,000, like this money here is really family and friends money. It would is how most people would get that, because you need someone who needs they need to know you, and they need to be investing in you and want to help you. And your family and friends are the closest, and that might be a distant relative. It may be a friend who just happened to do well in life. But it's probably not necessarily a professional investor. Crowdfunding, I'm not going to address in this. It's a whole nother level. So really, we started early with family and friends. Then we're looking at pre-seed. And I'm just going to take a look at some of these questions, because there's a bunch flying by here. So I am describing, there's a question about, am I describing a typical business to consumer type of startup? I said, yes. For the story doesn't change dramatically in business to business, just the market concepts change. So if you're not looking at consumers, you may be looking to find, say, two partners at the second stage here. Two partners that you work with that are beta testers of your product if it's an enterprise type of product. Whereas here you may have 10 paying customers. So these are 10,000 free users that aren't paying anything. And they have, this is the reason there's three of these is because it's a progression. I wanted to illustrate the progression, but ultimately your goal is to get 10,000 users in order to create value in your company. So generally, if we were to build something out like this, you would be looking at a funding amount here, like a value amount of raising $180,000. If you did well, you'd probably end up with about a $2 million pre-money, post-money valuation. So you'd sell about 10% of your company here. And then if you actually built that prototype that was compelling and built out your network properly, you can probably raise that to about 3 million here. Now, if you do a really good job here, you may be able to get this to 3 to 4 million in terms of your valuation at this stage in the company. But that is highly dependent on how compelling what you've done has been. I typically will take someone from an audience, but this is a virtual audience, and actually run through their story with them in order to build something out. So this is a little bit virtual, but the idea is that you want to break down what you're doing into very understandable steps that you know what you need to do to execute. And the more you can do without money that builds your credibility, the easier it will be to craft you'll learn more about your business, and the easier it will be to craft a story that you can then use to raise the money you need, because you'll know what money you need. You have a good story behind what you're going to do with that money, and you're going to be focused on what kind of value you're creating with your business. The most valuable risk you can mitigate in an early stage startup is the market risk. So what I hear people say a lot is, well, I need $30,000 to hire a user experience person, right? Well, that doesn't actually tell me as an investor anything. I need to know what that person is going to do and what you're going to do as a business, so that you can prove to me that you can actually, what's creating value in your business. I think I do. So how much time do we have left?
It is 12:09 now. We have about 5 to 10 minutes of, you can keep going, or we can jump into Q&A.
Let's jump into Q&A, because
Sure,
I'd like to address people's direct
So I've looked
questions.
at a few of them so far, and I'm going to poll. We have a lot of repeat type questions, so I apologize if we don't get to all of them. I think right now, so we talked about B2B. I think there's a couple questions regarding mentorship, and this is also something we've had other people in other e-seminars request is, how many mentors do you have? How closely do you follow their opinions? I think we had a question here saying that they had a very technical pitch recommended, and how simplified to keep it, how to deal with situations and following your path forward, and then also what surrounding mentors are telling you.
Okay, so let's talk about building out a mentor network. So there is a common thing that entrepreneurs will get, and that's called mentor whiplash. So you will go, let's say you have 5 mentors. I'm just making that number up, but you want as many mentors as you can afford to spend time with, and who have either good networks or a lot of experience in what you're trying to do. And that could be just building products. It doesn't have to be a specific domain, but one mentor will tell you to do one thing, and another mentor that you meet with an hour later, who hears exactly the same words, will tell you to do the exact opposite. And it is up to you then to understand what your mentor's backgrounds are, why they are saying that, through questioning them and also through understanding their background. And and then the idea that because of them better, you're going to know why they're saying certain things. One of the skills of a great CEO is to be able to, or CTO or any startup founder, is to be able to take that mentorship advice and recognize it as additional information, but they have to internalize it and understand how to make the decision of what to do with that. Sometimes you'll throw that away because you just weren't able to communicate all the elements, right, to the mentor, so they can't give you advice that's relevant. Or you may take it 100% in and really change what you're doing with that. And that is one of the skills of a great startup founder, is that they're able to balance that. There's no magical number of the number of mentors. What you want to do is identify the holes in your experience set and the holes in your team. And you want to then find mentors or advisors that are relevant to filling those holes. The compensation for mentors and advisors varies widely. It can range anywhere from 0.1% of stock options to 1% or more, depending on how much time they're going to spend with you and how much value they're going to create. And that is something where there's a lot that's been written on the internet for that. So I would just Google that question and read 5 or 10 articles about it.
A couple questions just to aggregate what we're learning about. Why is it important to not spread yourself too thin, especially as a lesser experienced founder entrepreneur? A lot of people are talking about how they have an idea that is both a hardware and software company. Mm-hmm. We see this in our bootcamp pitches, that people have a product that requires both of those things, and why that's really difficult to get off the ground right away.
Sure. So at Betaspring, we did fund a few hardware companies. So I have experience in how difficult hardware can be. Generally, if you are as early stage as has been portrayed kind of in this example, which then you're really not looking at raising money to build out your final product or even a prototype in the beginning. You're really looking to, you may just invest in a looks-like prototype versus a works-like prototype, but generally you'll do a looks-like prototype and a works-like prototype before you go out and raise the money to actually manufacture anything. And for those that don't know what that means, a looks-like prototype, you could be anything from something carved in foam that's been hand painted to something that's 3D printed but doesn't actually function, right? Again, I don't want to assume people's locations, but generally access to 3D printers and maker spaces, et cetera, in certain countries has come down in cost dramatically. And so the quality of a looks-like prototype is expected to be fairly high these days, which requires an industrial designer or someone else who knows what they're doing, which could be an advisor who's just guiding you on what to do. And then the second piece, in terms of a works-like prototype, it doesn't have to look anything like what the final product is going to be, but it needs to be done on an Arduino or something else like that. If it's an electronics piece, that at least has the functionality. And then you show both of them at once to an investor, and then they have to believe that you can put them together. So that would be the answer to a hardware like startup. So
so you had briefly mentioned the value of your team over possibly just the value of your product. But a couple people talk about the volatility they're experiencing within their team. Do you want to talk about why an investor might and why they value that so much in a good team is at a premium? Because for example, there might be an opportunity in which there's a pivot in the actual product, and why that ground is so important.
Sure. So especially in the early stage of a startup, there's a lot of chaos. You're essentially taking chaos and creating structure out of it, and doing so, creating some kind of value for people who are going to be using your product, or service. And a team that can navigate that chaos and the back and forth and can communicate well, and can support each other, and then can integrate that feedback and what they've learned and change so that they are evolving quickly to the needs of the market, just a startup is just a business that's trying to develop a business model that is unproven, right? So they're trying to get to a point where they have a business model and they know how they can make money. Yes, that is my website, by the way. Someone just popped up. So the idea is that you need a team who can navigate that and who can stick together. And it is a roller coaster ride. And sometimes people will be up and sometimes people will be down. And the best kind of co-founder is one that's going to balance you, right? So they're going to support you when you're up. They're going to be happy, but they're not. They're going to balance you a little bit. And when you're down, they're not down. They're up, and they're going to be able to pull you up with them. So you kind of have a more steady state in order to get things done. That is why people focus in on the team dynamics, the team structure. One of the big no-nos that we saw all the time was co-presidents or founding teams that didn't have a structure and had not assigned roles. So if that applies to you, I would definitely find someone to help you walk through that. So that's why team is so important, because you could have a great idea. You might have the best programmer on the planet to implement it, or the best hardware designer, but if you can't work as a team, you can't get anything done.
Yeah. So trying to look into some of the new questions. Some of them are pretty technical on specific topics. So I'm trying to see if anyone has any more general questions. I'm seeing a couple of things about risk, and I actually had a question that I think would be interesting for everyone to hear, and that's regarding financial projections and going forward and talking with possible investors and how to make sure that you're keeping it realistic. I think that's one of the hardest things for early stage startups to predict, and how to help that in your like acquiring new team members or whoever it is which you're trying to engage with. That can often be sometimes a deterrent, because they may seem too overreaching.
So I think people just have to, as a founder, you have to recognize the difference between your big vision and your next step. And both are important. You want to have the ability to articulate your big vision. Everyone talks about an elevator pitch, like that is kind of the big vision. But when you're talking to someone about seriously joining your team or raising money, then they are going to be interested in not just the big vision, but like, what are you doing next, right? Can you actually do what you say you're going to do? Because everybody kind of knows, okay, this is a 5 to 7 year kind of thing, maybe longer. But really what and they want to believe in the mission of the company or the vision. But at the same time, they kind of want to know that if you're promising them a salary, that you're going to be able to write them a paycheck. And they're going to want to believe that that's not just happening because you happen to be rich and have the money to write them a paycheck. They want to know that what you're trying to accomplish next is actually logical and can create value in the company. And even if they can't articulate that to you, that's what they're looking for. So really, investors and potential co-founders are in a sense looking for the same thing, right? What are you doing next? And this exercise is designed to force you to think about that and to actually be able to then work through this generally with an advisor who can give you feedback on whether that story flows well or doesn't flow well, and whether it's realistic or not realistic, or whether it creates enough value. So, one could debate, I've got the first thing, you're going to have several friends using the products and you're going to want 20 users, right? One could debate whether that's enough users or whether it's too many users, depending on what you're building and exactly what you're trying to do in the next step after that.
We had a question. This is an interesting one. Can this be applied to consulting firms and not just startups?
So yes and no. It definitely can be. I think that especially if you're a consulting firm that's trying to build some type of internal technology that you can then leverage so that we can charge more for your consulting hours than you normally would be able to. But generally, if you're going to sell something to a client, the number of clients that you've had in the past will build upon, if you're going out and trying to win a project that's $3 million, and you've never done any projects, the odds of getting that project are probably pretty low. But if you've done a couple $1 million projects, then you're probably have a much better shot at getting the $3 million project, and so on and so forth. So if you're going out in the consulting market and you don't already have a background in consulting and what you're doing, then generally what you'll see in terms of consulting companies starting, and I'm looking at tech consulting here, is that they will start with projects that are relatively small, $25,000, $50,000 kind of projects, and then that will lead them into the experience and the infrastructure that they need to in order to sell a larger customer. So in that case, your company is your product, right? And your talent and your company is your product.
I'm just going to quickly answer one of these questions. Someone asked, how can we measure our progress? I think we could go into that right now, but there's also a lot of great resources online about ways to build out financial targets, and also to create prediction structures, looking into your beachhead market and then making longer term projections. We had someone ask, how do you deal with unknown risks as an early stage startup? And I think there are often people do deal with this, having to make decisions without a complete source of information. And maybe how willing is your team to be more risk takers? And I think we've looked into people who are building teams with different workplace personality traits. So people that's similar to like DISC assessments. You have an innovator, you have someone who's strong in completion support. I think that there are strong, again, teams can be really valuable for that. But yeah, if you wanted to touch base about dealing with unknowns.
Sure. So there's always the what you don't know that you don't know quadrant. That is always the most dangerous one. Unfortunately, it's the one that always exists. You don't know what you don't know in terms of risks. You can minimize that, and part of a good advisory network will be to show you what the risks are that you have no idea about. But ultimately, people think of founders as risk takers, and I disagree with that. I think that good founders they have risk tolerance, but they are going to do the right amount of homework, and they're going to take calculated risks. So I'm going to just switch this a little bit, right? The reason you can't go out and raise $5 million on day one without anything is that you're giving somebody a huge risk to take, right? Give us $5 million. We've never done this before. We want to build this beautiful, shiny object in the future, but it's going to take us $5 million to do it. Please write us a check. Well, nobody's going to take that risk. So in building this out in stages, you are now taking risk. You are now presenting risk in very specific ways. So what you're saying is, if we get to 20 users, and if we build a prototype, and if we're able to add a user experience person to the team, by the way, we've already identified them. So we think we can do all these things. The risk of us executing these things is relatively low because we've convinced you through a great presentation or through several coffee meetings or whatever it is that we can execute this next step. The risk of this next step is relatively low. The risk of success is quite high. The risk of failure in the future is still quite high, but the risk of failure of the next step is much lower. Then I only have to believe, one, that you can do the things you're saying you're going to do, and two, that by doing so, you're going to raise the value of the company, and you're going to get to a stage where you can now raise the money you need next to survive and to do the next step in your growth. So by presenting the company evolution in logical stages, then you can now convince people to take the risk on the next stage, not the whole thing, right? And what a sophisticated startup investor understands is that as long as you have a team that's adaptable, they're going to change what they're doing. And they better change what they're doing because the odds of being right about what they're doing on day one are extraordinarily low. They just don't have the experience or insight. And if somebody existed who did, then their idea would have already been done and it would have been successful and it wouldn't be a startup anymore. Yeah. So it's not really about being a risk taker. It's about how do you structure the risk so that investors and customers are willing to take it with you. And you're also taking that risk. You've convinced yourself and your team that if we raise $180,000 under this model, we can do these things. And that will create enough value for us to raise money that we need in the next stage.
Great. So we have about 5 more minutes. I think we had a couple more pointed questions. Let's see. So we had one. You can talk about giving. There's a couple options. We can see which ones you think maybe are more pertinent. We had a couple questions regarding, giving away equity to mentors, and I think maybe you could talk about the value of that mentorship, or how much mentorship you are looking for, and then also, developing credibility and reliability when you're very early on and you don't really have much of a background. How to present yourself in a way to show that you are maybe a reliable person to work with. So maybe those are 2 different topics. But
yeah. So in terms of the equity that's given away, I touched upon it briefly. Typically but I'll go into more detail. Typically advisory equity is given away in kind of vesting over 2 to 4 year periods, depending on the amount of equity and how well you know the advisor and when they're creating the most value. But let's just say that, again, you may give away anywhere from 0.1% of stock options vesting over 2 years to 1% or 2% over a longer period, or even more, if the person's creating enough value. But you need to figure out when they're creating the value and make sure that they're earning that value. From a startup founder's perspective, what you don't want to do is get into a contract with an advisor that you're locked into when they're not creating any kind of value. So advisory agreements, you'll find out there, are generally pretty much at will. And so there's a mutual trust that's necessary. Once you get into I'm going to bring you a major customer and then I'm going to earn a specific set of, that's more of a sales agreement than it is advisory agreement. So you'll see those as well. And then the second question, what was that again?
Developing credibility when you don't really have much to show, and when you're solo without much money.
Yeah. So what you need to ask yourself is, what is it that you can do by yourself, and that will help you either tell a better story to get other people to buy into what you're doing. Maybe you tweak your idea so that it's not exactly what you thought of originally. If you're mission driven, people think of this a lot in nonprofits or non-governmental organizations or mission driven startups. Those missions are more than that person, right? And more than some product off the shelf. It's something that that people really care about in a larger sense. And so you're trying to get better at telling that story. Attach yourself to startup communities, whether that's online or in person, right? Because you need to, if you want to become a successful entrepreneur, you need to be around other entrepreneurs and other people that are trying to be those entrepreneurs. Because if you don't have a co-founder, which I highly recommend you find one eventually, you're going to need the support of those communities to kind of make it through the process. So most people have some set of skills, even if it's just storytelling or if it's just building something. And the goal is to talk about it to as many people as possible so that you can find other people that resonate with what you're doing. Now, one of the mistakes that a lot of founders make is they don't talk about what they're doing, or they try and keep it secret. Unless there are real legitimate intellectual property issues, which sometimes there are from a patent perspective, then it's a big mistake, because you need to find the other people that care about what you care about in order to build your team.
That's great. I think that's a great place to end, especially as we're just closing up. I would like to thank Owen for coming today. It's been a great e-seminar, and we saw a huge attendance. We appreciate all of your responses. To anyone that is going to be attending our venture scaling seminar, bootcamp, in the coming months, we very much look forward to seeing you. Please stop by and speak to any one of our bootcamps team. If you were here today, we'd love to talk with you more about our e-seminars. But once again, thank you, Owen, for coming by. We very much appreciate it. And tune in for our next e-seminar.
Great.
Great.
Thanks.
Okay, bye guys.